Hello, everybody, and welcome back to another fun day of intermediate accounting. So let's take a look at this question. This is exercise 1813. So we've got crankshaft company manufactures equipment. Crankshaft's products range from simple automated machinery to complex systems involving numerous or containing numerous components. Unit selling prices range from 200,000 to 1.5 million and are quoted inclusive of installation. The installation process does not involve changes to the features of the equipment and does not require proprietary information about the equipment in order for the installed equipment to perform the specifications. Crankshaft has the following arrangement with Winkerbane Inc. Okay, so this is extremely important information, okay, because as I was talking about in the other example from exercise 1810 and 1811, if crankshaft is the only one who can actually perform the installation, then what that would raise, and if I was a auditor, I would want to make absolutely sure that this is true, because if they're the only ones who are doing installations for the clients, and that could be for a variety of reasons, I would be extremely concerned, because then it's bundled. And I'll show you what that means in a moment. But what that means is that you really should not be recognizing any revenue until the equipment is fully installed and up and running. So very, very important part here. So let's go back over here to my probably out of order, and we'll find out about that a little bit later when I do the lecture. So what's the contract here? So they're going to install equipment, and then they're going to, or actually they're going to deliver equipment, and then they're going to install equipment. So we want to identify the consideration. It's basically $1 million. So Winkerbane is obligated to pay Crankshaft $1 million upon the delivery and installation of the equipment. What are the performance obligations? So there's two. There is going to be, so the contract, I'll write this over here. So my contract is 1 million. The consideration, or excuse me, the contract, good going, Tchaikovsky. Your coffee clearly has not hit in today. So install and, or somebody deliver and install equipment. The consideration is 1 million. The performance obligations are deliver and then install. And we're going to say that these are two separate obligations. Now, in terms of allocating the consideration to the performance obligations, we're going to go back to my fund allocation, equipment, and then installation. And the reason why we have to do this is that what it says over here, let's just go here. Let's see here, $1 million to install. Okay. Crankshaft charges the same price for the equipment, whether it does the installation or does not. Using market data, Crankshaft determines the installation service to have an estimated standalone selling price of $50,000. So the equipment is $1 million no matter what. The installation is 50 grand. So the total amount that the equipment and installation are actually worth is about $1,050,000. From a practical business perspective, a company like Crankshaft, especially if they're earlier on in their stages of development, they want to be doing the installations. And the reason is, and if I'm Winkerbane, I would also want them to have them do it, because if something goes wrong, then Crankshaft is responsible. Right? So it makes perfect sense to have Crankshaft deliver and install the equipment. And so again, if a client was telling me this, I would really make sure that these are truly two separate pieces. So why do I have to do this? Well, my consideration is $1 million because that's what the client's paying me. The value of what I'm giving is $1,050,000. So what I now need to do is I now need to say, okay, what is the percentage of total? So I'm going to take basically this million divided by 1,050,000. And I'm going to take 50,000 and divide it by 1,050,000. And when I add these up, this has to equal 100%. So this is my allocation. So then my transaction price is $1 million. So if my transaction price over here is $1 million, I then take B times C, and I'm going to get 952,000. I'm going to get 47,000 for a total of $1 million. Okay, so I've done the allocation. So how should the transaction price be allocated among the service obligations? Okay, so that's right over here. So I've done that allocation. Now I have to go through and recognize the revenue. So there's two different things happening. On June 1st, the equipment is being delivered. So on 6/1/20, right, I've delivered the equipment. So what I would be doing is I would be debiting accounts receivable, basically over here for 952,380. Okay. I would then be sales revenue. I would basically over here credit sales revenue for that same amount. Then I would debit cost of goods sold. And I would credit inventory. Okay, so why am I doing it like this? I've not started performing any of the services yet. Okay, again, you really, really want to make sure that these are two distinct parts, because this to me smells like you could really abuse this. Think about it. You dump the stuff at a client, you don't do anything for 3 months or 4 months, 120 days, it's sitting there, and then you're installing it. Yeah, doesn't smell right. Anyways, to record sale of equipment. Next one over here, it's going to be on 9/30/20. So on September 30th, what you then do is we're getting cash of $1 million. Okay. So at this point in time, I'm also, so they're paying me the full $1 million. So I'm crediting accounts receivable because they've now gone through over here and they're paying me this off. My remaining amount is going to be services revenue or installation revenue. Okay, my installation revenue over here is 47,000. So basically to record installation and receipt of cash. Okay, so let me just take a look right here. I'll be right back. Just want to see if there's any other tidbits. So and I'm just going to show you what the book is doing because this is different than what I am doing. The book is actually taking, what they'll do is the book solution is taking accounts receivable at $1 million. Then they're doing sales revenue, and then they do unearned revenue. And so over here, now my problem with this, and you've heard me say this before, is that when you're doing, this is a gross up of the balance sheet. And so what I mean by that is that you're basically recording revenue for work you haven't yet performed. And so that's why I'm doing it this way. I'm not doing it the way that the book is doing it. Not saying that that's necessarily wrong, but it would be something that I would want to go through and make sure that I adjust. So how is this creating a difference on my end? It's basically this: you recognize you're basically taking 2 steps instead of the one that I've done here via journal entry. I would accept either on a test, but I believe that this is probably going to be a little bit of a better approach. The one thing I want to end with you for this particular one is when I go to company filings, and we're going to go ahead and look up Apple. And when I was looking at this question here, I kind of said, well, why is it so important that we're calling this, product revenue versus services revenue? If you look here at Apple, right? Apple has two different or basically two different revenue parts. They have their product revenue, and then they have their services revenue. And I think it's really important for us to take note of that, because if I'm an investor, I do want to know, what are you making from each different line of what you're performing. One of the other parts of it too is that, well, how significant is that revenue segment? So this also kind of breaches over into materiality. If, for instance, I was going here and looking at Apple, do I need to break out my different parts over here between products and services? And the answer is you pretty much have to, because it's a very, very significant portion of the overall revenue. If I was to show over here in terms of between installation and what I want to break this out similar to Apple's, showing like basically a product revenue and then an installation revenue. Well, if I look at this from an overall standpoint of materiality, if I just take this, this 47,000 divided by a million, this is roughly going to be about a little bit less than 5%. Is it material? I would probably want to be showing it separately, or at least having it in the footnote disclosures of the financial statements. Again, the way this is worded, if I was an auditor, I would be all over this. And again, the client, and there's a reason why the client this is the way the client wants to record it, and it's the way that we're doing it for this. But this is highly suspicious, okay? So that's accounting during the morning with Professor Tchaikovsky, because now we're busting those accountants after dark. So have a great one. I'll see you on the next video. Take care.